Hello student, today we are going to continue our Forex beginners courses, and as you know, we are in the episode where we are learning the simple mathematics which we will be using in our daily Forex trading. Let's go for the next course after the intro. Welcome back to our new course of today, but before we do start the new course, let's do a quick recap of what you have learned on the previous course. In the previous course, we have learned what is PIP. We have seen that the PIP is a percentage in points or price interest points, which is the smallest change in a Forex quote. We have seen also that the PIP is the fourth decimal of a quote, a price quote for all the pairs except the Japanese yen pairs, and we've seen that PIP it is the second decimal of Japan yen pairs. We have seen that PIP it is equal to 1 of 10,000, which is equivalent to 0.0001. We have learned also about pipette. We have seen that it is 1 of 10 of a pip, which is the fifth decimal of a price quote, and the third quote of a price quote for the Japanese yen pairs, and we've seen that it is equal to 1/10 of pip. So this was an important reason because this small changes in the price quote, which we call PIP, it is what we will be using to calculate our profit and the loss in Forex trading. So I hope you was able to recap about this we have been learned. If you do not remember them, I encourage you to go to the link above on your screen and check on this lesson again. And if you are enjoying these courses, don't forget to subscribe to our channel so that we know when the new course is released. And don't forget to hit the like button and to share to other people so that they may also run these free courses of Forex trading. Without delaying, let's start our today course. And today we are going to continue with lot size. In order to understand what the lot size is, if we are selling or buying small units, you know, we do not buy one single unit. For let's take an example of eggs. If you want to buy eggs in a supermarket, you do not buy a single eggs. You buy either a box of some eggs or you buy a tray. For example, for sugar, for example, you cannot buy a single sugar because it is very, very small. We need to buy in kilos, in kilograms or sacks, something like that. So since pips is also very, very small in Forex, in order to trade, there are units of tradings, and this quantity of units of trades with which we trade in Forex, we call them lot size. So lot size is the number of currency unity which you need to trade or to make transactions while trading. The standard unit of lot size, we call it standard lot size, and it is always equal to 100,000 units of the base currency. So there are other lot size we use. A part of a standard lot size. We do have also the mini lot size, which is equal to 110,000 units of the base currency. There is a micro lot size, which is equal to 1,000 units of base currency. And nano lot size, which is equal to 100 units of base currency. The value per pips varies also depending on the units of the lot size you traded. For the standard lot size, the value per pip, it is equivalent to 10 pips especially for Euro USD, GBP USD. For other pairs, it can slightly be small. If you wanted to know how we calculate the people value for every pair, you can go to our website www.ultimatetraders.rw. But it is not even very necessary, because the Forex brokers will calculate this people value and plot it to your trading platform. For mini lot size, the value per pip is approximately $1. And the micro lot size it is $0.1, and the nano lot size it is about $0.01. We'll see later how we'll be using these numbers. These are the lot sizes we'll be using to calculate our profit and loss during trading. And note that some brokers give us the lot size while trading, and others gives units, these units. So you should know which one you will proceed with while trading. Let's continue with another thing which is very, very important in Forex, which we call leverage. So leverage, it is the ability to control a large amount of money by using a very small money, a deposit of money by yourself, and by borrowing the rest from your brokers. Why do we need leverage, and why is it necessary in Forex trading? Remember, we have seen that PIP, it is 1 over 10,000 unit, very, 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 very small. So in order to make a profit, we need to trade a very big volume of asset which we are trading, and without leverage it will quite be impossible for retail traders like you and me to make a profit. Therefore, the Forex brokers, they offer a leverage, which is the capabilities or the ability to trade a very, very huge amount of money by only depositing a small amount of money. This is what we call leverage. Let's see an example of leverage. For example, if we have a Forex broker which has a leverage of 100/1, this simply means that to trade $100, you only need a deposit of $1. Then he gives you ability to trade $100. This means that you can trade $100,000 by only owning an account of $1,000 from this particular Forex broker who has a leverage of 100/1. So from this account of 100,000, you see that you can make you can now make money. Remember that we have seen that this is equivalent to somehow a standard lot size. Remember that we have seen that the value per pip of standard lot size, it is $10. So this clearly means that if you are trading this amount, if the market moves only 10 pips, they are enough to make a profit of about $100 for some pairs, of course. So you see that leverage is very important, but we will see later not only very important, but it has also the disadvantage if it is not properly used. Another number which we are going to take care of, it is what we call margin. Margin, to understand it better, let's take an example. If you want to go to bank to get a loan, the bank will request you a certain percentage of the money you want in order to give you the rest. Let's say, for example, you want to get a loan of $10,000. The bank will require you a deposit, let's say, for example, of 30%. to get this loan of 10,000, which means that you will need at least 3,000 US, your own money of US dollar, and the bank will give you the rest, 7,000 US dollar. It is the same in Forex. So in Forex, in order to execute any trade, you must have a certain amount of money which you need to the broker needs to deposit side as a guarantee in order to be able to make trades. This amount of deposit the broker set aside for a certain particular trade, we call it margin. So the margins are different from broker to brokers. So this will be one of the particular things you will need to check up while choosing the broker which you are going to use for your trading. Let's see an example. Let's say you have an account of $5,000 and the broker you are trading with has a leverage of 100/1. And let's say you see that you wanted to trade the USD Japan yen. You wanted to trade the USD Japan yen, and you wanted to trade one standard lot size, which is equivalent, which in this case will be 100,000 US dollar, because we've seen that the standard lot says 1,000 units of the basic currency. So to get this amount, because your broker has a margin of 100/1, it means you will need only a margin of 1,000 with this leverage. This clearly means that from your 5,000 account, a $5,000 account, your Forex broker will only put aside 1,000 US dollar for this particular trade, and will give you the capability to trade 100,000 US dollars. This is to protect you from to protect your account from going negative if things goes long, or in other words, if USD Japan yen does not go in the direction you traded it. So this clearly means that the maximum you can lose, even though this trade they lose, it is only $1,000, because it is what you have been, which has been set aside for this trade. And in case you win, because this money, it is not a fee, it is a deposit. If your trade goes like it was planned, this money will be turned back on your account after you close the trade, and the profit will be added to this balance. Let's say, for example, you trade this pair and it goes well, and you make a profit of $500. So this 1,000 will be turned back, which was a deposit or a margin, will be turned back to your account. 5,000 plus the 500 you earned. So after you close the trade, your account will be 5,500 US dollar. And in case you lose, let's say you lose and you lose 700 from this trade. So the 700 will be deducted from this 1,000, which has been put aside as a margin, which means that you will remain with 5,000 minus 700, which means that your account after this trade will be 700 US dollar. Not that the maximum you can lose, it is only this margin. I hope you understood this number and how they work. And now let's see how we do calculate the margin for a particular trade. To calculate the margin, it is equal margin based leverage is equal to the total value for transaction over the margin required by the trader. Let's as I said, there are different margins, and every broker has his own margin, as have been said earlier. Here we have margin in ratio, and here we have a margin in percentage. We can have a margin of 500 over 1, 400 over 1, 200 over 1, 100 over 1, 50 over 1, and there are even brokers which can give you the average which have a margin of 1,000 over 1 etc. So this, they have the equivalence of a percentage. If for example, you have a broker which has a leverage of 500 over 1, this is equal to 0.2%. It is simply 1 over 500, which is equivalent to 0.2%. Leverage of 50 over 1, this is a leverage of 2%. Let's see an example. For example, if you want to trade a standard lot size of US dollar for this particular broker, we have seen that you will need this. You need a margin of 1%, which means that you will need at an account of about $1,000. For this broker, to trade this one, you will need 2% of this account, which is about $5,000. You will need $5,000 to trade this account with this broker. For this one, you will only need an account of 500 and so on. So this is how we calculate the margin required to margin-based leverage. To know how much you are going to risk from a particular trade, you must know the leverage which your broker is offering, and you can either write it as a ratio or as percentage. Let's continue with our numbers and see the effects of leverage. Leverage, even though we have seen that it is good, that it gives you the ability to trade a very huge amount of money, but it is a double-edged sword, because it has the potential to enlarge your profit and loss at the same magnitude. What does this mean? This means that the higher you have leverage, the higher the risk you have. By going back from this number, you see that, for example, here, if you have this leverage, you will be required a small margin, of course, but you have a big risk if you lose. So you should play safe with leverage, and you have to know how to use it properly. Let's see how it can be very dangerous if it is not properly used. Let's take an example of two traders, traders X and the traders Y. And these traders, they have both account of $10,000, and they want it both to trade Euro USD. And the broker, they are using the same broker which has the margin of 1%. You see that up to here, to this point, these things, they are all equal. But during the setting up of the trade, let's say this trader X decided to go 500 times of the trading capability of this account, which will be 500,000. And trader Y is smart enough, and he knows the effect of leverage. He decided to go 50 times of its capacity. So this is 50,000 instead of 500,000. Let's say if the market goes 100 pips in a loss, remember that for 1 pip for Euro USD for standard lot size, it is $10. This clearly means that for 500, this is equivalent to 5 standard lot size. So for this, every pip, this trader will be losing $50. So if he loses 100 pips, he will lose in total $5,000, which is 50% of his total account. But he will, and his capital will remain at 50%, which is also 50%. For this one, if he also lose 100 trades, 50,000, this will not be even 100 standard lot size. This will be only 5 mini lot size. And as you remember, the value per pip for mini lot size is approximately $1. It means for 100, this will be for 5 mini lot size, will be losing $5 for every pip, which means that after 100 pips of loss, he will only lose $500, which is equivalent to 5% of his account. So you see that after this trade, these both traders make both trades with the same account, same pair, same margin, and they lose the same pips, but the difference, it is only at the leverage. You see that this will lose more than this one. This is how leverage can affect our account if it is not properly used. Of course, this is loss. If it goes well, this trader also could make a profit of $5,000 by moving 100 pips. This could move make only $500 also. Of course, this is what we said, that the leverage has the power. So this is how Forex leverage can affect you if it is not properly used. Of course, if things went well, this one could make $5,000 and this could make only $500. But to be more profitable in the long run in Forex, we prefer to make a small profit many times, which gives you your curve to be growing over the time, instead of making a huge move and then make a loss and go back, move, go back. At the end, you end up losing your money. So we better use the leverage properly. You do not have to be afraid about the leverage. You will know and see how to use it properly, and it will work well for you. So this is some of the numbers we'll be using in our Forex daily Forex trading. And if you wanted to know more, go to our website, Ultimate Traders RW. You will get more information about the leverage, margin, and value per pip and the lot size. And please, if you enjoyed this course, don't forget to hit the like button and to share this course to other students so that they know also about this Forex mathematics. Let's see each other in the next course. Ciao.